It is a privilege for me to introduce our next speaker. It's important to understand, although the Commission does not formally have a strategic partnership with Bridgewater Associates, this is a firm that has done a great deal to help the staff, whether it's looking at questions of currency valuation, whether it's looking at the discussion of economic growth and risks therein, or if it's a discussion of corporate culture. This is a firm that has offered a lot to us over the years, and I think also this meeting historically has been at WAMP, and it's hard for me personally to recall a WAMP meeting where we didn't have Bridgewater here to share their views with us. And today here we have Paul Podolsky. Paul is a portfolio strategist at Bridgewater. He's a senior member of the research group with specific areas of expertise in structuring foreign exchange, interest rate, commodity and equity market trades. He also works with Bridgewater's clients to develop investment strategies that meet their objectives, to provide insight into the research group's thinking on global markets and economic conditions. Paul has been with Bridgewater Associates since 2004. Prior to joining Bridgewater, as though he needs more of a resume than that, Paul was managing director and head of interest rate and currency strategy at Fleet Boston Financial. So, without further ado, Paul Podolsky.
Thanks very much.
Welcome, Paul.
How long do we want to
Yeah, I need
Paul
the
go?
sign.
We need to be his governor, because he can go long and it'll be fast.
It's all good stuff.
Let's try for 4:30.
For 4:30.
And the only reason I say that is I have to leave at 4:30, and I'm happy to turn over to Ed at that point, but that seems like a pretty good time anyway.
Okay.
45 minutes, yeah.
We'll aim for that. So thanks again for having us back. Really appreciate the opportunity to talk with you, and I hope it is a talk. I've got a lot of slides, but I've always in the past had great conversations with this group. And as I was sitting back here listening to the presentations, wow, have things come a long way. I remember in 2006, I believe it was, in WAMP on one of the initial conversations about changing the way this pool of money was invested. And if I recall accurately, it was at the time 50% in equities and 50% in domestic bonds.
It was in March 2006, March 31.
Okay, all right, so I remember roughly correctly. For some of the commissioners I've met before, for those of you who don't know, Bridgewater, we're a money management firm based in Westport, Connecticut, about an hour north of New York City. All we do is manage money for institutions, and we just have two strategies. One's strategic, passive, and the other one is tactical. You've got them both. And our mission with investors is to do two things, which is be a good return stream and be a good strategic partner. And the return streams, I think in your portfolio, as you guys know, have spoken for themselves. And hopefully today is another chapter in the dialogue we've had over the time. Now, that's all the good news. It wouldn't be Bridgewater if we didn't come in and offered you what we call the unvarnished truth about the way we see things. And I'd say there's sort of three big picture points that I'm hoping come through in this discussion and in these slides. The first thing is actually over pretty much the entire time that we've been working with you, we've been in one of the most extraordinary periods of time, economically and financially, really since the 1930s. That has made trying to understand what's going on in the moment and understanding what's going to come in the future very important, not so much to rely on our own professional experience, because what we've been going through has been very different than what the 80s or the 90s looked like, and more really step back and think about how the machine, how an economy or how a market prices, to understand what the pressures have been at the moment. There's no clearer explanation of how unusual the environment has been, which is in '06, if I told you that I'm going to come back and speak to you in November of 2013, and the Fed's balance sheet will balloon to trillions of dollars, interest rates will be zero, real interest rates will be negative, the the Fed will have been effectively giving money away for free for years. I think if I'd asked this group, or pretty much anybody, what do you think inflation would be? And pretty much everybody would have said sky-high inflation. If inflation falls any lower in the United States, it'll be a concern. So that's the type of environment that we've been in, and I'll explore a little bit of why those forces have been there and when they're likely to dissipate in these remarks. So that's one big theme of how unusual this environment is. The second thing is that the tools the policymakers have applied to deal with these challenges have solved one set of problems and created another, and that new set of problems is directly relevant to your challenge. The problems they've solved is you've averted a deflationary depression. That's no small accomplishment, because that's the path you went down in the 1930s, and I'd argue that's the path that Europe, particularly periphery Europe, is going down headlong right now. However, by averting one set of problems, they've created another set of problems, which is that they've had to depress the value of cash and drive up the value of assets. And even though that's been a tailwind in your returns in the most recent years, which I think the numbers reflected, it creates a headwind on your returns going forward. We estimate that the average returns of the typical U.S. public or private pension fund are going to be substantially lower over the next 10 years than they have been historically. We're estimating that the total return of many of these pension funds could be in the realm of a 4 to 5%, the way most of them are invested. I'm not saying that's exactly what your return is going to be, but that's substantially lower than the 8 or 9% that people have experienced historically. And it's a lot lower than what the targets are that many public pension funds are aiming for. And this comes down to, there's a lot of complicated language you can use around this, actuarial and discounting rates, etc. I would just put it in plainer language. You got a pile of money right now, and you got a lot of payments you got to make over the future. Now, the pile of the money is a little bit smaller than what you ideally should be funded at. And if you have a smaller amount of money compounding at a lower rate over a long period of time, that creates real problems in the future. So the first point I'd make is unusual environment. Second point I'd make is there's a real challenge that we're seeing to returns going forward. And the third point I'd make as we go through this is there are no easy solutions. You're going to have to choose between different goals you want to aim for and different risks that accompany that. It's not like there's going to be an easy path to travel that all of a sudden solves this problem. So that's really what my message is, those 3 points, and I'm going to walk through and illustrate them. And I realize that they're not the most uplifting way to end the day. We don't come out here with a goal of trying to depress people. All we're trying to do is just walk through the numbers and see how it works. So before I jump into the pictures, any questions so far? Okay.
Well, I guess just one question. From what,
Sure.
From what you just said, does that put the onus on external forces away from what we do to increase contributions, for instance, to do something to offset exactly what you're talking about?
That would be one possible way of changing the dynamic. I would say ultimately it's going to have to come down to one of, say, 4 different things or a combination of them. That would be one source, more money coming into the plan.
Of course,
Another
that's one thing
thing-
we have zero control over.
Right.
Yeah.
Right. Another thing would be to say, so I'm just laying out the way this works here. Pardon me if it's a little bit politically incorrect. The other thing would be to say, we're not going to make as much money as we said we're going to make. The other thing would be to change the asset allocation. And then the last thing would be to take more tactical tilts in your asset allocation and be right. Those are basically the 4 different things you can do. Now, there's only 2 of them that you can control, which is the strategic asset allocation and the tactical tilts. And even with those, there's tough choices. In other words, you could say our goal as a group is we're going to meet that return target. And we're going to do, and I'll walk through some of the pictures about how, different options, things you could think about. We're going to engineer this portfolio to meet that return target. And that's going to be absolutely what we're going to be focused on. And you know what? If we look different than somebody else, peer risk for 1 year or 2 year or 3 or 4 years, we don't care. Now that's probably solving for one problem, which you have a bigger pile of money, but it's creating another problem. Peer risk is not a small thing. This can be a big issue, and I think there's, this committee and others have dealt with that. Or you could say, listen, we want to focus on, the best way to do this is to put the onus on the external forces, and we're going to focus on minimizing peer risk, and that would lead you down another path. That's just dealing with the strategic asset allocation, and there's a whole series of questions about how you would maximally be able to take tactical opportunities in the market. If you look at your portfolio right now, we don't have a deep knowledge of all the tactical tilts you have on your portfolio, but some of the tactical or alpha that you've added to your portfolio has worked for you guys. But it's only a small percentage of your overall returns. So that's another lever you could pull on the portfolio. Anyway, that's a lot of words to a pretty straightforward question.
As you go through it, and it's one thing I know Herschel's going to take up probably in February, but rebalancing policy, right? I mean, there's your asset palette, there's tactical bets, which are more sort of active, however they're determined, and then there's more passive or rebalancing framework. If y'all have any thoughts on that, I mean, it's something that is within our purview.
I would probably, for the sake of clarity on the committee, if it were us, I'm just going to give you the advice what I would do, and if I was a member of the committee, I would think of your choices in terms of slotting them into either it's strategic or it's tactical. So if you're going to choose when to rebalance, I would say that is South Carolina doing internal tactical. And you could have a framework for doing that, and I would apply the same high scrutiny you do to those internal choices that you do to Bridgewater. Because I know when we go through portfolio review, it's not, we got to have everything tied up so we can explain every single trade, the ones that have worked, the ones that haven't, et cetera. You could do that, but I would just apply that same rigor that you do to your external managers to those choices. All right? So I was going to talk briefly about what's going on in the world, so focus on sort of theme number one, which is the extraordinary environment we've been in, and then transition to what the implications are for asset classes, and be mindful of the time as we go through this. In terms of the environment, I would say point number one, we're 5 years into this process that we've described to you in writings and in talks as a deleveraging. I think when we introduced the term, it sounded a little bit unusual, but now people become more accustomed to it. Basically, you can have long periods of time where an economy is accumulating debt, and for the U.S., that was from the 1950s all the way up to 2008. And then when you switch from the period of time of accumulation to reduction, the economy feels very different. For the simple reason that one of the main things that creates spending is gone. Spending is just a function of how much you earn, your income, and how much you borrow. And if the borrowing is negative as opposed to positive, by definition, you're going to be spending less than you have been. And that's the process that the U.S. economy has been going through, which is that the Federal Reserve has lowered interest rates, but there's not very much borrowing. And the reason there's not very much borrowing is because in aggregate, people's balance sheets aren't strong enough to take it. So that creates lower growth. Now, that's been happening not only in the United States, it's been happening in Europe, it's been happening in Japan. Through most of the developed world, that's been happening. However, if you look through conditions in the developed world, you see very different conditions in different regions solely as a function of what policy has been pursued as you've gone through this. The United States has had an extraordinary response by the Federal Reserve. But one of the challenging things when you're in a deleveraging is a lot of policies that can seem intuitively like not necessarily a shrewd idea. Actually, when you're in an environment as unusual as a deleveraging, can be a good idea. And we would describe what the Federal Reserve, although controversial, what it's done as falling into that camp. If you look at that, the private sector has been weak. It's been offset by stimulus from the public sector, and that has kept the U.S. on a gradual pace of improvement. Unemployment is still very high, but it's gradually been coming down. That's the U.S. We see the U.S. economy as being weaker than average, and this is going to impact the pricing of stocks and the pricing of bonds, being weaker than average, but not terrible, over the coming period of time. Europe looks terrible, and the main reason that they look terrible is because, unlike the actions of the Federal Reserve, the European Central Bank has been reducing its balance sheet as opposed to expanding it. And I'll share a framework in a few moments, but spending, again, can only come from how much you earn, how much you borrow, or how much the central bank is printing. The printing in the U.S. has been on, and it's been off in Europe, and you can see that in terms of unemployment, you can see that in terms of equity performance, et cetera. If you look into the emerging markets through the first period of this, I would say 2009 until recently, the emerging markets were in a big boom, even when the U.S. was doing relatively weak, and that was a huge offset to the weakness you were getting here. Many of the companies you would hold in your equity index earn an enormous amount of money from their sales abroad. And even though the U.S. was weak and Europe was weak, other parts of the world were strong, and that helped buffet them. We think that that's unlikely to continue in the same magnitude going forward for two reasons. The first thing is that some emerging market countries are running into the same debt problems that the United States did. A more moderate version of that, but they've basically overspent. And those countries are pulling back now. And if you look at a country like in India or Turkey or South Africa or others, they are now struggling with that. So there's not going to be the same boom from EM there was. The other issue is China, which has just been on a tear, is now looking to cut back on the amount of credit growth it's had in the economy, and it's slowing. It's growing quite quickly now, but it's likely to slow over the coming period of time as they try to reduce that rate of credit growth. So I would say the world is in an okay place, but it's a very fragile place if you step back from it, because the U.S. has been dependent on the Fed, Europe looks so weak, and the EM, you're beginning to see problems emerge. This model for those, this sort of framework for those commissioners who have been with us for a while know that we come back to again and again, but I think it's a useful way of cutting through what's going on with the various different countries. And I would say any economy at any point in time is just a function of three different things happening at the same time, which is that countries grow over time. They have a long-term rate of productive growth. The U.S., the normal rate of economic growth is about 1 to 2% a year, going back over 100 years. But around that 1 to 2% growth rate, there's booms and busts. And they come because of expansions and contractions of credit for the same reason I said before. It's the income plus the borrowing. The income doesn't move around that quickly. The borrowing can expand and contract. Typically, the way you get out of an economic bust, so if the economy, as opposed to growing at 1 to 2%, is growing at 0 or contracting, the way you get out of it is that the Federal Reserve lowers the cost of credit, interest rates come down, and the private sector responds, and they spend. And then you get an upturn, and that's what we mean by the short-term debt cycle. If you look at basically every major downturn for the U.S. economy since World War II, that's how you get out of it. There is, however, another dynamic, this long-term debt cycle, that's worthwhile being aware of, which is that if you are at the point where everybody has taken on so much debt, which is where we were in 2008, this line, let's say, went from the 50s up to 2008, the economy can weaken, and the central bank can lower the cost of credit, there's no response, and the economy actually goes into free fall, as do markets. It's because you're linked into a self-reinforcingly negative process. My spending is your earning. If I'm pulling back on my borrowing, it hits your spending. If you're levered, then you got to do the same thing, and it feeds on itself. This process, you can sort of see this illustrated here. This is just an example of the U.S. Here's a long-term debt. This chart on the upper left here goes back to World War I. Total debt divided by GDP. That's what I mean by a long-term debt cycle. And there's the top right there. And then here is interest rates dropped all the way to 0. That's what I'm showing here. These are short-term interest rates. And then at that point, the Federal Reserve began printing a ton of money. So that's what I mean by shifting the dynamic. Now, this has had a material impact on pension funds. Because remember, the goal is to be returning 7 or 8% a year off of a pile of money that is growing in line with what you owe in the future. Basically growing today's money to pay off this huge pile of liabilities. Once you suffer one of the big downturns that you suffer in a 2008 type of environment, it can take years and years to recover. And that drawdown in most pension portfolios, and then the one around the technology wreck in 2001, caused a lot of pain in terms of people's ability to make money. I would say this printing that you see here, it's not a U.S. thing, it's a global thing. This is it showing it in global terms, and you can see it for different countries here. All countries are struggling with this dynamic right here. And this relates directly to, I would say, the second issue I was raising. So the first issue was this challenging economic environment. The second is what it means for asset class returns. So I want to go through here and now transition to that point. But any questions about the economic dynamic? Disagreements, questions, anything you want to talk about?
Well, just going back to what you were talking about with India and China and some of the emerging markets, is it an oversimplification to look longer term at a place like India and China where you have urbanization, you have a significantly growing middle class year after year after year, rising wages and so forth? Does that ultimately contribute to better economic growth? I would think so, wouldn't it?
It does. It's not an oversimplification. Actually, I'm a big fan of oversimplifications myself, so I'm kind of I think in the long term, China and India can grow relatively well. And we would estimate that their long-term growth is going to be substantially above that of the United States. What I was trying to say is that in the short term, if you're sort of estimating out another year or two, are you going to have that same vibrancy of demand from those places that you have had over the last couple of years? I'd say no. In a more medium-term picture, you're right. However, one thing I'd add to that is that doesn't necessarily translate into an investment thesis. Just because they're growing more quickly doesn't mean that if you invest there, you'll earn more money. And that's somewhat counterintuitive. And let me just, because that's a key point, because what some people are doing is they're looking around at this picture in the United States and Europe and they're saying, that's awfully depressing. Let's invest in some place that's growing quickly. And this is an interesting example of it. This year, China, most emerging markets, India for most of it, have been growing much faster than the United States. However, their equity returns have been low, and the United States equity returns have been high. Counterintuitive. The reason is the equity return in any of those markets is a function of what happens with their growth relative to what was already expected to happen, reflected in the price of the equities that you're buying. There's the earnings, and then there's the PE, the discounting of those earnings. So if you look at emerging market equities, they're already anticipating a relatively high level of growth from those countries. For EM equities to outperform, growth needs to be even higher than that. So yes, you could get better growth from there, but I wouldn't necessarily say that's a solution to this pension problem. Is that?
Yeah, so I guess what you're really saying is that expectations, plus or minus, have a significant effect.
Huge.
Yeah.
Huge. And if you look at, I didn't include them in this presentation just for the sake of space, but if you look what happened, the companies in those countries made money. They just made less money than people were thinking they were going to make because you ran into some of these problems that I was describing before. And when that happened, people had to reprice the equities, notwithstanding the fact that the overall growth rates in those countries were above the growth rates here. So I agree in the long-term thing, but boy, it's not a solution necessarily to the problem. Doesn't mean you wouldn't want EM assets in your portfolio. You would, and we have EM assets in the portfolios we invest for you. It just means to be mindful about how they price. Any other issues in the environment before I switch to the assets and the returns? Okay. I'm watching my watch dutifully. I know it's been a long day. Okay. So this is one of these frameworks that I alluded to before, and I think it's really useful in terms of looking at what's going on in the U.S. economy or any economy. If you want to understand what economic growth is going to be in any economy, just think about what the sources are that are going to create the spending. GDP is just measuring how many dollars are spent. And for GDP to be growing, the sources of spending need to be growing. There's only really three sources in the U.S. or any other economy. There's income, there's borrowing, and there's printing, what I was saying before. And these can be seen pretty easily. Income is most directly related to the unemployment rate. And even though unemployment's coming down, it's not coming down at a rate that is really leading to increases in wages. This is household credit borrowing right here. This is as a percentage of GDP. So if you had a 10% borrowing of GDP, U.S. GDP is about $16 trillion. So 10% of GDP is, at the peak of the credit boom, there was an extra equivalent of $1.6 trillion of spending going into the U.S. economy. That's a lot of money. It's plummeted here, and this is what's going on right now. So even though you're giving money away for free, households, by and large, aren't taking the bait. They're not borrowing that money, which means that from these two pieces, which is the private sector, you're not getting a lot of spending, which is why the Fed has had to fill that gap. Now, this is a key linkage. The Fed can do one thing and one thing only, which is it can print money. That's the one unique thing it can do. However, it can't spend the money. It can't say where the money is spent. The federal government can say where the money is spent. The federal government could decide to build a new aircraft carrier or railroad or something like that, but it can't print the money. So what happens when you get into this environment is the income and the borrowing are weak because of the deleveraging. The Fed steps on the gas here, and then it really is useful to visualize what next happens with the money. Imagine I'm the Federal Reserve and you're a bank. You're not lending any money because you don't see any people who are going to pay you back, and there's all this regulatory reform, you're just scared. So you're sitting there borrowing from the Federal Reserve at zero and investing in treasuries. If I'm the Federal Reserve, I call you up and I take all those treasuries off your balance sheet and I give you cash. The key thing is what next happens with that cash. If it goes into loans, it goes into spending, and then it goes into the economy. But it could also just end up either right back at the Federal Reserve. In other words, I could give you cash and you could post that cash back at the Federal Reserve. Or you might use it to go out and buy another asset. I bought a 2-year bond off of you and you go out and buy a 3-year bond. Or maybe you buy a corporate bond or a mortgage bond. What's interesting is if you look in the lower left right here, and it's a little bit difficult to read on the screen right here, but the red line here is household spending and the blue line is household wealth. So think about the blue line is asset prices and the red line is spending. The money that the Fed is printing is by and large going back into reserves at the Federal Reserve, or it's going into asset markets. It's not going into the economy. Now that has a couple of very important implications. The first thing is it explains why inflation is so low. All inflation is the price of goods divided by how much money and credit is chasing those goods. Not much money and credit is chasing those goods, which is why inflation is so low. That was the big surprise from 06, 07 to now. That even though you get all this printing right here, not much of it was going into the economy. It has been going into asset prices. Now, that's helped stabilize conditions in the U.S. There's been a wealth effect. Stocks are up. House prices have stopped falling. However, what it's meant is, if you look at the lower right here, is the pricing of assets has risen. The previous speaker just said that equities are fairly valued. That's a big change from where they were. This has big implications going forward, because if assets are all fairly valued from here, it's not like there's a big catch-up to come. Moreover, if the economy is as weak after this much stimulus, it's not like you're going to get a big increase in cash rates. Assets price relative to cash. One of the reasons that asset returns have been lower is because cash is at zero. So if you look at the combination of asset prices being up and cash rates being at zero, it can, in our minds, create a very challenging environment for returns going forward, which is what I'm illustrating here, and I draw your attention really to this bottom chart right here. So we tried to build a process out where we can estimate what the return of asset classes are going to be, not over a 1 or 2 year time frame, but more over like a 10-year time frame, which would be relevant to you. And when you put together that combination of low cash rates and relatively elevated pricing on the cashing as a function of what the Federal Reserve had to do to rescue the economy, to us it looks like expected returns going forward are going to be low. Total returns we're estimating, and this isn't precise, but it's something like a 4 to 5% estimate as a function of the consequence, if you will, of the rescue that was put into place. So item number 1 was extraordinary environment. Item number 2 is really this chart and the logic behind it in terms of the challenge it creates for asset returns going forward. The final point I'd leave you with on that before we turn with sort of, we could either just have questions and answers, I could dig into more of the environment or what the tools are to deal with it are, what this literally practically means for pension plans going forward. If you just visualize that concept of, I've got, I should know the numbers offhand, but I don't, $28-29 billion roughly, to be able to meet my future liabilities going forward in time, which are going to rise as a function of inflation and then expected increases in on real wages going forward, I have to have a pretty high rate of return if I was 100% funded to meet those expectations going out. Given the fact that I'm not 100% funded, and if you look at the top chart right here, this is just for public pension funds, and the bottom one is including public and private. We put an estimate here for public and private. We use as a benchmark something like an 80% funding rate, which is probably generous for some, conservative for others. What does that spell for the future? Well, if you're supposed to earn up here and you're earning down here, and you're doing it on a lower pile of assets, you're going to have a problem. And that problem actually grows through time, which is what this chart shows here. So it's basically what rate of return would you need right now to be able to get to be fully funded. And then that changes over time for each year that you have a lower rate of return. So this issue of an extraordinary environment, asset class returns are probably lower than usual, and this putting a real point on the challenges of meeting your target returns is probably one of the biggest issues that would be top of our mind if we were sitting in your shoes trying to manage this pool of money. The remaining pieces I have for this are a framework for how we think about what to do about this, or digging more into this environment by country. So I want to use your time as effectively as possible. You want to ask questions? You have specific issues you want to dig into within this?
Yeah, you can.
Head to the framework.
Yeah, let's know what we should be doing.
Okay.
You've told us what we can't do.
Well, being aware of it is a useful thing, and through conversations with the staff, et cetera, we've gone back and forth. Is this right? Is this not right? So at least being aware of framing the challenge, I think, is useful.
Yeah, Paul was going to say, it's like you said here, it's very important to recognize that this is not South Carolina-specific information.
Correct.
With that said, it does give an idea, because we are underfunded at this point in time, that if you aren't earning that 7.5%, the difference is getting larger. And that means that you have to have much more than a 7.5% return on a go-forward basis to make up those difference, because, like you said, that amount of asset pie is getting smaller. And so I think that's a very good slide that highlights the potential, as we talk about, risk of the portfolio.
This is probably one of the biggest risks, and I think that it's very useful just to literally think about, for the typical pension fund, you guys would be more familiar with your specific situations, but what percentage of your assets are you paying out each year? Literally, how much cash is going out the door? And what does your rate of return need to be just to keep up with that rate of cash going out the door? And for many funds, you see that the amount of cash going out the door is something like 4% of their assets each year, which means you got to have a rate of return higher than that just to keep up with that. So it's a pretty significant challenge, I think, that many institutions are facing. Yeah.
Paul Herschel mentioned the 7.5%. What is the top chart here? 7.5% for us is 7.5% actuarial rate over 30 years. What is 8.9% over what time period? Is that per year? Or?
This would be for this year. It's basically if you take a typical U.S. public pension plan, and you basically say, given their funded status and given what their expectations are of return going forward. In other words, you literally try to calculate out what the cash payments are going out the door. What rate of return would you need to have this year to be able to meet that goal? So it would be even higher. So what does this say? 8.9%. And that if you don't do anything about it now, and you go forward till 2019, then what would that number look like? If you wait 10 years, what does that number look like? Well, then you'd have to be earning 13% a year. So if you wait 10 years for this to happen, the problems just compound. That's what those numbers illustrate.
So to apply that to the actuarial perspective of 7.5 compounding over 30 years to get fully funded to meet, if you were to cut off the obligations in 30 years, same principle applies, right? If you don't hit the 7.5, then that.
Correct, because you have those constant cash payments going out, so then you'd be off of a slightly lower base. That means you have to earn even more the next year. That's exactly right. All right, again, watching this the time. Okay, so in terms of what you can do, there's really only two levers you can pull in our mind. If you build a portfolio, there's three sources of return, and only two of them you can control. The first thing is the rate of return on cash, which is set by the Federal Reserve. Can't do anything about that. All asset classes price relative to cash. That's important to note because it can lead to a lot of confusion. In other words, if you look at 10-year Treasury rates and you say they're 2.7%, and you say that's a disaster, it's interesting to note that those interest rates are actually high relative to cash, not low. Typically, over the lifetime of this plan, the cash rate set by the Federal Reserve would have been something like 5 or 6%. On top of that, the 10-year Treasury would be 2.7%. So assume the cash rate was 5. If the Treasury was yielding 7.7, many people would say, great return. The thing that has changed is not the assets, it's the cash rate. And the assets are just pricing off of that. Treasuries price relative to cash, and then stocks price relative to Treasuries. So they're all tied up in this together. So there's the cash rates, but again, you can't do anything about that. The two levers you can pull are basically your strategic asset allocation and the tactical shifts. And the reason why I break them out is that they're distinct, unique sources of return in your portfolio, and it's worthwhile being aware of that. The strategic asset allocation, what in some of our materials we call beta, is the return you get from parting with your cash and investing in any asset class. It doesn't matter whether it's liquid or illiquid, whether it's a bank loan or a bond, an inflation-linked bond, a U.S. stock, an emerging market stock, it doesn't matter. For you to part with your cash and buy that asset class, over time, you would have to get a positive expected return to do that. Or else you'd never invest in the first place. There are so few sure things in investing. This is about the only sure thing we know of, that if you invest in a pile of assets, you'll get a return over time. That's one source of return. And the key question you could ask is, what's the most reliable, diversified way of getting that return? The other source of return, the tactical opportunities, is trading, basically. If we're both in the stock market, and you buy a stock, and I sell it to you, if you're measuring the value of that activity and you strip out the return of cash and you strip out the return of the stock market, only one of us can be right in that transaction. So while strategic asset allocation gives you a guaranteed positive return over time, trading markets does not. Actually, if you include transaction costs as a negative expected return in aggregate. So these things are just two fundamentally different, if you will, sources of energy in your portfolio. And it's worthwhile being aware of them because lots of times people will come up with ideas. I could do this, I could do that. Just remember that the minute you begin diverging from your strategic asset allocation, you're trading. And that may be good or it may be bad, but realize that once you do that, you've sort of entered the dark water where the sharks are. And you just got to be shrewd when you get into that dark water because there are people watching those markets. And if you're buying, they're selling it to you. They're selling it to you because they think you're wrong. And it's the same thing for Bridgewater, by the way. So we don't get involved in any tactical opportunities unless we literally figure that we can research and understand that thing better than anybody else in the world because we're paranoid. And I think that's important to keep in mind. Now, I will say, though, that tactical opportunities can be a great source of return if you can pick the minority of people or do it yourselves that win. And I know that some of the alpha managers in your portfolio have done that for you, and it can be an excellent source of return. And if you're good at it, and an institution like this that can call its resources to bear sometimes can do a great job at that, the current contribution of this to your portfolio is pretty small. And I'm not saying this to get business. We're closed, as the staff knows. I'm just saying that it's a useful thing to be aware of in terms of portfolio construction. So if you are thinking in terms of the way you do about it, this is basically I would describe as the knobs on the machine. Okay, there's strategic allocation and there's tactical. The only four knobs at the end of the day this commission can turn are these. The first thing is you could increase the consistency of your portfolio. And the term that was used earlier today with the consultant and others was the Sharpe ratio, the return per unit risk of your portfolio. I think about the miles per gallon of portfolio. You could make changes in your portfolio to give yourselves a higher return for the risk you're taking. So if your current portfolio gives you a 4% return, and you think about that as sort of like a 10% risk with a 0.4 ratio, that's what those numbers would mean, you could try to make that ratio get higher. And there's techniques you could use to do that. If you employ those techniques, we think they'll work, but they'll also create a lot of peer risk. So that's a choice. The other thing you could do is you could just take more risk on your portfolio. We looked at your numbers, and the numbers, as far as we can tell them, is your portfolio risk that you're taking is about 12%. You could take more risk. Now, if you have more risk, you'll get more return, and you have a higher risk of running into problems downside in a 2008. In 2008, typical fund lost 30%. If you were taking double the risk, you know what those numbers look like. And the same applies to the alpha, the tactical opportunities. You could try to improve the quality of the managers you have, or doing it yourself, or increase the risk. And while it's beyond the scope of this presentation, as the staff knows, we have tools, analytical tools for both this and this that we're happy to help you with, to help you look at techniques to be able to improve these portfolios on either side, either helping analyze the managers and get the best out of them, or the others. The big point I'd make in this, and I realize we've only got a few minutes left, is, again, some of the commissioners will have seen this. This is the framework I'd be thinking about if I was going down the path of trying to improve the ratio or the consistency of the portfolio. What this illustrates here on this page is, it shows a number of asset classes here, 20 different asset classes in a portfolio, and it assumes, takes hypothetically, say you have a portfolio, and you have a single asset class in it that has a 10% risk, volatility, and a 0.25 return to risk ratio. So in plain English, you part with cash, you buy an asset class, and it's going to give you 2.5% a year with 10% volatility. That's the way you'd read the numbers on this. What happens to the portfolio as I add more assets to it on the strategic side, or I add more managers to it on the tactical side, as this number goes up, what happens to the efficiency of that portfolio depends a lot on how related those investments are, how correlated they are. And the biggest advice I could have for you, both on the beta side and on the alpha side, is try to focus a lot on having strategic investments that are really different from one another, and tactical managers that are really different from one another, and then take an appropriate amount of risk on them. If you actually, I'm going to jump through these slides, you can literally, final thing I close on, you can literally, this is what I mean by engineering a target return, you can literally say 1.5% is the 5-year cash rate. Here is the risk of your beta, right here, the ratio on it. You can actually pencil in a number for what that means. You could pencil in a number for what that means, and you could work backward here and say, what am I going to actually have to do to earn my target return? And you know, if you're aiming for 8%, if you just set this number right here at 8%, you got a 50-50 chance of reaching 8%. You'd have to set it at something higher than that to be confident that you were going to exceed your performance target over time. So if it were us in your shoes, I'd ask myself, is this true, what we're saying about the environment? What is the expected return I could get from my portfolio? I showed a range here. If you assume the lower side of this range, if you want to use the most conservative numbers you can on this chart for your total return, I would assume a 0 cash rate here. That's what it is right now. It's supposed to be this in 5 years. We just took this from the bond market. What if they're wrong? Assume this is 0. Assume this number right here is at the low end of expectations, about 4.5%. What would you do? And that's not including the alpha. You guys might have, we didn't put that calculation in because we'd have to run that in a thoughtful way to be sure it was appropriate for you. What do those numbers look like? And what could I do to change those to be more confident going forward? And for any change I make, there's going to be cost to doing that. So if I make a choice, what's the cost to that? And on that, at least I'm on time. On that rather depressing note, that would sort of be our core framework for thinking about your challenge.
Thank you a lot, Paul. That was great. I don't know if is it the pleasure of the commission that did he answer questions, or are we more interested in adjourning?
I'll just make maybe one quick comment, and I think this is great, and this slide is fantastic as we think about, we talk about risk and the peer risk a lot here, And, the commission on the left side here, the risk piece of it, we've intentionally tried to take less risk because we don't need another drawdown like 2008-9. And we've really focused on diversification. We're trying to get that Sharpe ratio up, as you said, and then the alpha piece. So that's really where we've been focused on. So I think that's a great context to think about the levers of where the commission has been focused. So,
Yeah, for what it's worth, I think that the path you guys have been on has been excellent. It's been bold. It hasn't been exactly what everybody else is doing. It's been excellent. And here, if I were on the committee, what I would be pushing for is doing more of it, not less. I would be pushing for doing more balance here, for getting really clear on what the tactical, how good you guys are at selecting managers or doing this yourself, and based on the track record of that, sizing those so they make more of a difference. If you look later on in the presentation, I won't flip to them for the sake of time, you can see where you are here in terms of how diversified and how big the tactical opportunities are as a function of the overall plan. And that is, so if it were me, I wouldn't be looking on levering up the whole plan because I think another 2008 could come, and you know what? The Fed might be less successful the next time around, given how big asset prices, how much assets have already responded to what they've done. So I would want to have a plan in place in case there's a downturn and in case the Fed struggles. And I would be different than what some of the other, what I heard some of the other people. I think that one of the most widely, everywhere I've heard, the stupidest thing you could ever do in your portfolio, the worst idea, which always makes me think that maybe it's one of the better ideas, but anyways, it's sort of, is to hold any fixed income in your portfolio, particularly bonds. God, you'd have to be, well, I don't know, I'd be thinking about, are there ways you could include those in your asset allocation so that they help meet your return targets, but also provide downside protection if the economy does turn down again? I'd throw that out there as a provocative idea. You got to move at your own pace, and you got to do things that are appropriate for this institution. But if it were me, try to focus on getting the ratio of this up and trying to get this piece in place so it's going to do even more for you would be where I would, where I would head.
Just one last question. You referred earlier, or a little while ago, to our portfolios, and used a figure of 12%. But what was that 12%? Was that?
Volatility.
Volatility right here. That's this right here. We
Oh, okay.
calculated that. We could be wrong, but we just took your asset allocation as publicly published and estimated what the volatility of it was. And that's the number we came up with.
it's about, yeah.
Okay, Paul, that was great.